Hey, thanks for tuning in. In this video, I'm going to talk about Ford stock and what's been going on. You can see here from Ford's stock price chart over the last few months, the stock price has fell from over $13 per share around September. It crashed all the way down closer to $9 per share in early November before bouncing back up above $10 per share as of this recording. So a lot of what's been happening with Ford stock can be explained by what management said in their latest conference call. So I'm going to dig through, I've already dug through that conference call and I've selected the key information that's causing this change in Ford's stock price in my opinion. So I wanted to share that with you, those of you that are interested in Ford stock. So let's get right into that.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the big thing, of course, if you've been following Ford in the last few months, is the agreement with the United Auto Workers Union. Ford management announcing that they're pleased with this agreement, although it will cost the company more money. And it's one of the reasons, this is highlighting one of the reasons why, if you've been following my channel, you will know that I'm not a fan of car companies, of car stocks. And one of the reasons for that is because of the strong negotiating power of its workers, right? That means that whenever Ford starts to do really well, the union will recognize Ford's improving prospects and will negotiate for higher wages, which will bite into Ford's prospects. Now, the flip side of that is that Ford can secure workers for the next few years. It can have that contract stability in terms of labor, but at the same time, it reduces the upside because whenever, if things start to go really well, the workers are going to come in and say, well, share some of those benefits with us. Whereas in other companies, in other industries, the negotiating power of workers is not as strong. And it's not the only reason why I'm not a fan of car companies. You're going to see another reason why a little bit later on in the video. And I've talked about several reasons why I'm not a fan of car companies and car stocks. Overall, just my personal opinion, my personal investing style, I'm not a fan. But I understand the allure and the interest from investors. It's understandable, especially with Ford stock with a strong dividend yield and trading at an inexpensive valuation. I can understand why investors are attracted. But let's continue here. Management saying our business is never short of challenges, especially right now with the evolution of the EV market and new global competitors from China, as well as technology disruptions. And that's been the story, right, for 2023 is electric vehicles and the reality that's setting in for the EV industry, right? Coming into 2023, there was all these rosy forecasts, all these rosy predictions of how electric vehicle sales are going to grow exponentially for the next 2 decades, and there's going to be no slowdown. It's just inevitable. EVs are the future. That's just what it's going to be, and everybody else who disagrees is wrong. Well, 2023 is proving some of those skeptics from the EV industry right. In fact, the Toyota CEO went on some sort of a victory tour lately telling investors, like I told you EVs are not going to be smooth sailing as everybody thought. And aren't you glad that I invested in hybrids as well as EVs because I understood that this was going to be a challenge. And it has been a challenge, and you've noticed several EV companies, starting with Tesla, with massive price cutting to get customers to buy electric vehicles. Organic demand for electric vehicles has tapered off. People are realizing it's not very convenient. It takes a long time to charge an electric vehicle, especially when you compare it with how long it takes you to charge, or not charge, but just refuel your vehicle with gas. And so that reality is setting in for a lot of consumers, and governments are incentivizing both the supply of electric vehicles and demand for electric vehicles with thousands of dollars of incentives. But even that hasn't been enough to spur demand, right? It's still growing, the industry is still growing, but the problem is that the supply of electric vehicles is also growing at an exponential rate. Some would argue that the supply of electric vehicles is growing faster than demand for electric vehicles. Those figures are hard to pinpoint, but let me show you this figure here. So here I have a chart according to Statista of overall automobile production, overall automobile supply, and at its peak there was close to 100 million units per year produced of vehicles overall. This doesn't separate between EVs and regular vehicles. This is just overall EV production. Now there was a significant slowdown due to the pandemic and all the supply chain shortages, but it's slowly rebounding. And even the mild rebound is causing trouble in the industry for electric vehicles because look over here at its height, 100 million vehicles supplied, and worldwide car sales were around 67 million units in 2022. 67 million, right? When you can produce 100 million and you're only selling 67 million, that's a problem. That's an imbalance between supply and demand. And in order to increase demand, when you've got such an imbalance, you've got to lower price significantly to get demand up closer to where supply is. Closer to where supply is. Now, the car industry benefited in 2020 and 2021 and early 2022 and mid 2022, you can say, because supply was constrained. And so you had a better balance between supply and demand, and profits absolutely exploded industry wide, whether you're an electric vehicle seller or a traditional vehicle seller. Profits were exploding, and that's been true for Ford. That's been true for nearly every car company in 2020, 2021, and 2022. But now that supply chain problems are easing and supply is increasing, it's going to create a lot more challenges. And I think the challenges are going to be more acute in electric vehicles because organic demand from consumers is still not there yet for electric vehicles, while supply is exploding, right? Billions and billions of dollars have been invested in manufacturing capacity for electric vehicles, and a lot of that supply has been new supply. It hasn't been converted from traditional vehicles. So you've had this $100 million capacity, 100 million unit capacity in 2017, 2018. Now add to that all the billions of dollars that have been invested in creating electric vehicles. But you still got that traditional vehicle capacity, and then on top of that now you're adding millions more units of EV capacity. So capacity for these vehicles is soaring, and so prices need to come down to get consumers interested in buying cars again, right? Paying $10,000 above MSRP, which was common in 2021, 2022, I think is going to be no longer the thing that's going to happen anymore, especially in 2024. So the Ford CEO, what he was talking about here is kind of highlighting those challenges now that the market is normalizing coming out of the pandemic. Still, Ford is America's best-selling brand through 3 quarters in 2023, even with the effects of the strike. And now they have a wave of new products coming in the next few months. The new F-150, the Ranger, a brand new Explorer, an Expedition, and Navigator. Yeah, Ford has some of the strongest brands in the United States, and sales have been strong for Ford. Profits have been strong, especially because of what I mentioned earlier. Ford has been selective in producing. Since supply was constrained, it could pick and choose which one of its models to produce, and it was producing only the highest profit margin models and telling consumers, well, if you got to take what we're giving you, otherwise somebody else is going to buy it and you're going to be left without a car. And since consumers were faced with supply shortages, they were going ahead and purchasing whatever was given to them, right? But now that supply is increasing, it's slowly not going to be the case where consumers don't have choice. They're slowly having more and more choice. So Ford Blue is Ford's segment that has its traditional vehicles, and management saying that will continue to be strong and it'll continue to be a growing business for years to come. And I agree, right? I agree. More than 9 out of 10 consumers are still choosing to buy traditional internal combustion engine. More than 9 out of 10 consumers are still choosing that. Even with the thousands and thousands of dollars of incentives, still consumers are choosing internal combustion engines. More than 9 out of 10. right? So it's going to need a lot more investment before electric vehicles can become a favored choice from consumers. It's not there yet. It's not going to be there in 2024 either. So Ford still remains bullish on the Model E, which is its electric vehicle future, but clearly the market is a moving target, right? It's another words of saying like the market is not what we thought it was. It's a lot slower. Customers are smart and rational, right? Customers are smart and rational. I think this is another way of Ford management saying like customers are smart. They realize that electric vehicles are extremely inconvenient and more expensive to buy. So why would consumers choose that, right? They're smart, they're rational. They're not going to just go and choose an EV. But for many people, EVs are a great choice. For many people, and I would say for some people, not many people. For some people, EVs are a great choice. I would say 1 out of 10 people. According to the data, about for 1 out of 10 people, EVs are a great choice. For the rest of the public, the internal combustion engine still is the better choice for the rest of the public. And so Ford management saying a great product is not enough in the EV business anymore. We have to be totally competitive on cost. And that's true. You can't just say, look, here's an electric vehicle, buy it, right? That's not the case anymore. Consumers want competitive cost now. They're comparing, when they go to a dealership, they're comparing EVs with other cars and they're saying, it still doesn't make sense for me to get an EV. You got to bring the price down lower. You got to make it more convenient for me to own an EV. Right now, still not there. So while Ford's Generation 2 EVs are targeting to deliver an EBIT margin comparable to internal combustion engines by 2026, the dynamic changes in the market, pricing, adoption rates, regulations are forcing us to further reduce the cost of our EVs. In other words, Ford management saying we were thinking that by 2026 our EVs were going to produce a operating income similar to our internal combustion engines. That's what we were thinking initially. But now we're changing that thinking because of what's happening in the market, because of what we're seeing in the market. We're changing that thinking. They're not saying they're reducing it or setting it out, but that's next to come in my opinion. First, they're saying we don't know if that's going to be true. If this market persists, which I think it will for EVs, I think price cutting and slower consumer demand will persist. I think Ford will then come to terms and say, you know what, it's going to take longer for EVs to be comparable to internal combustion engines in terms of profitability, in terms of operating income. And they've reacted accordingly with their production, right? They pushed out production targets, they pushed out supply increases because they're realizing that the forecasts they had where they thought, okay, we're going to produce 1 million units and we're going to sell at an average selling price of X. They're now realizing, you know what, we don't think we're going to be able to sell 1 million units at this average selling price. It's either going to be lower units sold, or if we want the same number of units sold, we're going to have to lower our projection for average selling price. And that's going to hurt profitability either way. Either lower units or lower average selling price will hurt profitability. So they're reducing their investments in EVs, which if I was a Ford investor, I would be happy with that slower investment in EVs. I wouldn't want them going all in on EVs just yet. I've been more a fan of what Toyota has been doing, which has been a slower investment in EVs, going more towards the hybrid route. And also Stellantis has been slower in transitioning to EVs. I've been more a fan of that strategy because the infrastructure is just not there yet for EVs to go all in behind it. The charging stations, the home charging, all of the infrastructure that's needed to really promote electric vehicles, still not there yet. And that's okay. This kind of thing takes time. It's a lot of physical investment, right? A lot of commodities, a lot of metal, a lot of people, a lot of things need to move, and it's expensive, billions and billions of dollars. Trying to grow that industry too quickly, I think is not prudent. I think it should grow a bit slower to make it so that it's longer lasting. So I think this explains a lot about what's been going on with Ford and what's been going on with Ford stock. A certainly interesting story if you've been, following electric vehicles and you've been following legacy automakers. Ford is kind of like in a nice sweet spot there where it still has the internal combustion engine segment that's doing really well, and it's given that part of the business has delivered billions in profits and cash flow that's allowed it to invest in electric vehicles. So an interesting story to be sure. If you enjoyed this video and you want more free content just like this one, you will want to subscribe to my channel. I cannot overstate how important it is for you to subscribe. With just a click of a button, you can help the production of more free financial analysis for you to enjoy.